get ready, man. I'm passing you the ball. Looking forward to speaking with you. Welcome to F.A.C.E, Troy Bombardia. Everyone stick around for Troy. How you doing, Troy?
Yeah, I'm good. How's it going?
Good. You know, normally I don't do this till the end of an interview, but I went to your website and I read about you. So you are my trading warrior brother. You're a warrior, buddy. And you know, and definitely, you know, you never know what kind of faith or what you're made out of until you face adversity. That's my belief. We all do. And why don't you tell us a little bit about, before we get into, you know, what you're doing now? I know you were running a hedge fund. How did you get into the business? Who introduced you?
So actually, I do have a bit of family in the business. So I've always been interested in like the markets and stuff since I was in high school.
Okay.
And then straight out of university, started a hedge fund with a partner and just went from there. Yeah. So basically, with the hedge fund, we started it out in 2008. So during the market crash and all that.
Right.
And the thing is, we did pretty well the first year because it was like the fundamentals were so obvious. It was basically the economy's going down, and finance is the sector that's leading things down. So therefore, you want to be short the finance sector, right? And straight from the very beginning, I knew that I wanted to do leverage ETFs as opposed to, for example, futures, just because with leverage ETFs, at least in the worst case scenario, you don't get a margin call, unless of course you trade on margin, right?
Wasn't it a long only fund?
Yes. So long only, as in long only inverse ETFs. So for example,
all right.
Yeah, we primarily trade in SKF, which was the 2x inverse ETF for financials, right?
All right.
And like I said, because the thing is, and especially in a bear market, because the volatility is so extreme, it is very hard to calculate exactly how much margin you got to set aside for your futures positions. So it's just, especially in times of high volatility, you cannot be trading futures unless your position sizes are very tiny. And because we only trade the S&P 500 and the US stock market, our position sizes are massive, right? So it's not like we have 10 or 20 different positions that can offset each other in the event that one position has a margin call. It's just that one margin call will kill us. So that's why we don't take that risk at all. So basically, that was that.
I love the bearish ETFs, the F.A.C.E and I trade them. So I think they function well as well. You know, I like the triple leverage.
Right. So the thing with that is, it's like we have changed our strategy a lot over the years, and I'll tell you later what I think about leverage ETFs. But just going back to the whole 2008 thing. So in 2008, the whole thesis was basically the economy is going down, it's getting worse, right? And then 2009 March, we traded for a bounce. It did bounce, but we thought the bear market would continue because we subscribed to the whole thesis that the economy is still bad, so hence it should still be a bear market, right?
Right.
But what we didn't consider at the time is the stock market does not care whether the economy is bad or whether it's good. It doesn't care about it in absolute terms. It only cares about if things are getting better or worse, right? So, for example, if you look at something like the unemployment gains every month, right? It pretty much at the bottom, like the number of losses, it was at like I think it was negative 200K, and that pretty much bottomed around February or March, and that bottomed with the stock market, right? So it's basically saying the stock market doesn't care if the economy is if it's good or bad. It's just, is it getting less bad? And in 2009, it was consistently getting less bad, right? For example, I think it was in February of 2009, the big banks, their CEOs came out and said, our losses aren't as big as we thought. So by then, like, you had the first signs that things weren't as bad as people thought, right?
Okay.
So basically, we traded it from the short side throughout the second half of 2009 and lost a lot of money. And it's just, that was a pretty gut-wrenching experience because basically we shortened it and then we switched long right at the top before the 2010 big correction, right? So essentially we lost money on both sides of that trade. And then just that experience, and over the next 1 year, it made me reconsider a lot of things. It made me basically question every single commonly viewed conventional belief about trading and technical analysis, right? Because before that, we were basically combined fundamental analysis and technical analysis, right?
Yes.
And after that, it just made us reconsider who really makes money in the stock market and who doesn't, right?
Because what did you learn?
Right. So basically what that is, it's the stock market, it's based on a couple of simple tenets. It's one, the stock market has a long-term bullish bias, right? It goes up over a 34-year term. So if you can't even beat buy and hold by a significant percentage, then what you're doing isn't right, right? So basically saying if you can buy and hold the long-term trend, but if you can skip out on the bear markets and if you can skip out on the big corrections, so basically you skip out on bear markets, you skip out on big corrections, and during those rallies in between, you leverage up using a 2x or 3x ETF like SSO or UPRO, then your gains will be massive, right?
So no more short side because of that thesis for Troy Bombardia.
Right, exactly, because the stock market has a long-term bullish bias, which means that let's say you assume it's a bear market right now, right? For all you know, the bull market could continue another year before the bear market tops, and in that 1 year, you will lose a lot of money, right? Yeah. And it's also that because, especially with leverage ETFs, if you look at something like SKF, XLF made a new low in March 2009 versus October 2008, right? Because the S&P made a new low. But the way leverage ETFs works, just due to the erosion, SKF did not make a new high in March 2009, whereas like XLF did make a new low, right? So it's basically saying leverage ETFs, your timing has to be extremely accurate. You cannot hold it for the duration of the bear market because the erosion is going to cause significant losses. It's high volatility. That's what kills leverage ETFs. So it's just holding in a bear market is generally not a good idea. But because if you the stock market is very unique compared to other markets in that, for example, you tend to get these very long and consistent trends, right? Like, for example, 2013, 2017, right? Yes. And in periods like this, a leveraged ETF like UPRO or SSO will compound on itself like crazy. So, for example, let's assume the stock market, the S&P, goes up 10%. Well, a 3x ETF like UPRO isn't going to go up 30%. It's going to go up maybe 40 or 50% just because of the way the math works. The compounding causes it to go up by more than 3x.
Okay. All right, so here we're looking at the S&P. So are you executing that strategy? You know, you're not running a hedge fund now, so
no. So
I noticed that you enjoy coaching and teaching. Is it a subscription service?
No, it's not. It's not really a subscription service. It's just like if you need help, I'm happy to help. Honestly, I'm just in like semi-retirement mode. Because last year I had a pretty bad back injury. It was really bad. It was like 7 months. And then basically I pretty much could not move for those 7 months. And then it just made me reconsider like what's important in life and all that. Yes. So as opposed to, just chasing the dollars, just trading my own accounts and taking it easy.
Okay. All right. So where did you find the strength to rally?
The strength to rally from the recovery, from my injury. It's honestly, these things happen. Like I've heard it happen to other people too, and it's just you got to deal with it. There's really nothing you can do about it. But just going forward, I got to be more careful because I used to work out like crazy, and I just can't do that anymore. So it's getting older. You got to be more careful with your body. Take it easy.
You sound pretty young. How old are you?
29.
Okay. I'll trade with you.
Yeah. No, I just got lucky. I started in this really early. So, and also because I had whole family experience from this and all that. So I had a pretty good start from it. And so just going back to that, I've tried trading different markets, for example, gold, silver, US dollar, and I've basically tried all the standard strategies like technical analysis and all that. And basically the conclusion is every market has its own one strategy that works the best. For example, like Blake's strategy, I think is one of the best strategies for Forex because that's just the way Forex works, right? You get a lot of small and short-term swings, but that kind of strategy, the basically buy on support, sell on resistance, it's not going to work that well in the stock market because sometimes you get these massive, very strong trends that just don't stop like last year. And it doesn't even allow you to cover from one side. For example, let's say you're going long and short, right? Well, if it's a very strong trend, then it's pretty much guaranteed in the stock market that one side of your trade is going to lose money. And it doesn't really matter how you rotate out of your position. It's, for example, you go long and short in a very strong trend like 2017. It's pretty much guaranteed that you are going to have to cover your shorts at a loss, right?
Okay. Troy, do you try and identify sectors or just
no, I don't. No, I don't, because the reason for that is it is possible, but it is very hard to do so. So basically, whatever we're looking for when we're trading using models is basically we're looking for factors that consistently and accurately predict trends, or consistently and accurately predict which sectors are going to underperform or outperform, right? And it's just, we haven't really been able to do that. We haven't really been able to find which sectors tend to underperform and outperform. And I kind of get a sense of what should be underperforming and outperforming, but there's no way of actually modeling that using, for example, economic data or anything. It's just, for example, right now, you know that generally speaking, in the last phase of a bull market, you are going to have high-flying tech stocks outperform, which is exactly what you're seeing right now, right? Like Netflix, Amazon, and all that. But it's just, there's really no way to quantify that. And because the model itself is based on the S&P 500, you want to trade something that's as similar to that as possible, right? You don't want to deviate from that as much, because when you deviate, that's when you tend to have mistakes.
So what's your take on things after it became more two-way in early February, and we've been moving sideways for the past 3 months? Go ahead.
So with regards to the market right now, this is actually a very standard pattern for the last 1 to 2 years of a bull market. And we can take it from a fundamental or a technical perspective, right? Because over the long term, so basically what happens is in the stock market, the fundamentals drive the long term and the technicals drive the short term, right? Because that's just the two players. The fundamentals being like large investors, institutional funds, pension funds, and all that. They're not going to jump in and out of the market at, for example, the 200-day moving average. Because of their massive size, it prevents them from getting in and out of the market that fast, right? So they're forced to trade with fundamentals, right? Whereas traders, because they can move very fast, they use technicals, and because traders generally don't have that great of an understanding of fundamentals, it's not what they teach you. It's not the standard stuff in school. For example, GDP is going up, hence it's bullish for the stock market. GDP is going down, it's bearish for the stock market, right? It's much more nuanced than that. Basically, it's saying from the fundamental perspective, yes, we are approaching the final stage of the economic expansion. For example, if you look at the initial claims right here, right? You see that initial claims are very low historically, right? And that it can't get much lower, right? But from other perspectives, you see, for example, new home sales right here, it's that new home sales are still rather low, historically speaking, right? So basically, the idea is that, yes, you do have some room for the economy to expand, but you don't have a whole lot of room to expand, right? And so basically the data is showing just continuous signs of expansion, and there are no significant signs of deterioration right now. And the thing is, there are certain leading economic indicators like initial claims right here, right? And these indicators tend to deteriorate for a sustained period of time before a recession and before a bear market begins, right? So right now, you don't see any signs of sustained and significant deterioration, but because the data is so good, you're watching out for that in case it does happen, right? But
yeah, we're back to the 1970 levels here.
Exactly. It is very low. And then it's just, you don't really know when the data is going to start to deteriorate, right? For example, people thought it would have bottomed at like 300K initial claims. It didn't. People thought it would bottom at 250K. It didn't. So basically, there's no point in guessing. All you can do is react to the data. And you don't have to guess, because with leading economic indicators, because they lead the recession and they lead the stock market, you just have to know what the leading indicators are doing. And then once you know that, you'll know what the next long-term phase of the stock market is, right? So that's the long term, basically. The long term meaning that, yes, it is still a bull market, and yes, it is still an economic expansion, but it's not, you don't have a whole lot of years left, right? Because just things are so good right now, right? So like going straight, so basically you want to take it from the long term to the medium term to the short term, right? And then so if we shrink it down to the medium term, it's a lot of studies basically show that, for example, we have a lot of studies here. It's basically just showing that 2017 was a year of an extremely strong rally, right? It wasn't a particularly big rally in terms of magnitude, but it was very consistent, and that volatility was very low. I think it was like the longest rally in history without a 3% pullback, longest rally in history without a 5% pullback, and volatility was ridiculously low, right? And it's, yes, that is rare, but it is not unprecedented. It has happened throughout history, right? And whenever that happened throughout history, what always ended up happening was that one, you got a correction, and then the stock market made a new high, and it kept on making new highs, but it did so in a very choppy manner, right? So whenever you find studies like this, and whenever you think of the results behind these studies, why is it that when you have a very strong persistent rally, you get a correction, and then you get a very choppy rally that goes to new highs, right? Why is that? So the psychology behind it is simple, because when you have a very strong rally like last year, the stock market has that constant buy the dip mentality, because there's too many like retail investors, too many mom and pop investors in it, right? So then basically when the stock market has a very strong rally like last year, that rally is still ingrained in people's minds, right? And because the economy is still going up, so people are saying, yes, this is the opportunity to buy the dip, right? But at the same time, because you are nearing the end of the bull market, because you're nearing the final 1 to 2 years of the bull market, you are getting some smarter traders, some smarter funds starting to sell down their stocks, right? So it's that constant tug of war between the people who are buying the dips and the people who are earlier and who are starting to sell. That's what caused the volatility to go up, but it's also what caused the stock market to go up, because in the stock market, there's just the buy the dip mentality is so strong, because you got to keep in mind most people are buying, right? Retail investors, they're pretty much always buying, right? Because that's what they were trained to do. And then pension funds, they're pretty much always buying because they have to hit their whatever target, right? And it's just basically you have to wait until the problem becomes so significant, the economic problem becomes so clear that the dumb money can't ignore it anymore. And when they can't ignore it anymore, that's when the bull market tops.
Okay,
So basically,
so this is this page we're looking at. This is your website, correct?
right. So basically, it just has a lot of studies on there. You don't have to read it, but basically all the studies are just, it's basically just saying this is a year where the stock market's going to go up, but it's going to go up in a much choppier fashion than last year, than 2017, right?
Yes.
So what that means is this year is going to be more conducive for example, day trading and short-term trading, right? And what you end up realizing is that a lot of day traders, they have to ask themselves, why is it that you're making money? It might not be because you're making money because you're right, but it might be because you're making money because the market environment just suits you, right? For example, I've started a day trading model for this, and the model's buy and sell signals aren't very, they're not that great, but the accuracy rate is very high, because when you get a very choppy market like this, as long as you hold your position long enough, and as long as your position isn't big, right, because you're day trading, then it's pretty much guaranteed that that position is going to make money, because it's choppy in a sideways range, right? It's high volatility. So it's more so just the market environment that's conducive to short-term day trading. And obviously that strategy last year would not have worked because the market just went up nonstop.
Right. It was buy and go away.
Yeah.
Okay. So this is a great resource for people to get your views, and this the best way for people to reach you. And is it bullmarketsco.com? Like
No,
your
it's
Twitter handle?
it's just bullmarkets.co.
Bullmarkets.com. Okay, Troy. Really was very nice to meet you. Anything else you want to wrap it with?
Yeah, just a couple of pointers. It's that, so for example, right now it's it's earnings season, right? And you get a lot of people saying earnings can't get much better, and what happens if earnings disappoint to the downside, right? But the point is, and for example, other things like, for example, interest rates are going up, hence it is bearish for the stock market, right? But the point is, that's all conventional wisdom. Has it actually been back tested? What is the historical correlation between rising interest rates and the stock market, right? And it turns out that rising interest rates, for example, aren't actually that bad for the stock market until, for example, the 10-year yield gets to 4.5%, right? And it's the same thing with the stock market and earnings reports. It's that, yes, generally speaking, an individual stock is going to go up more often than it goes down when its earnings report beats, right? But it's what the stock market does after the earnings report that counts, right? For example, if you were to look at 2016, the Q2 earnings report, which came out in, I think it was July 2016, right? It was a very strong earnings report, but the stock market was pretty much flat, right? And some people saw that as bearish price action for the stock market. The thing is, the stock market was flat during the strong earnings report, and it started going up after the earnings report, right? So basically, it's just saying that in the stock market, price action doesn't work that well as it does in, for example, Forex or commodities, right? And it's just the way the stock market works. Like, there's too much retail money in it, and it just kind of washes out a lot of the technical support and resistance lines, right? And for example, you look at the S&P 500, it found its support on the 200 daily moving average, right? Now, is that moving average going to hold or not? It's pretty much a 50-50 bet, because it's mostly technical traders that look at the stuff, the 200-day moving average, and the stock market is not dominated by technical traders, right? So it's basically, you got to question a lot of the conventional wisdom that trading and technical analysis teaches you, which does work in other markets, but it doesn't work that well in the stock market.
Okay, that's an interesting theme to wrap it with, Troy. We're here at, all of us here at F.A.C.E are rooting for you to have a great comeback, and not even need the public, and for a hedge fund, and that you become as big as your hedge fund before you were wrong.
Right. Thank you. Okay.
and it really was a pleasure to meet you, and you have a great grasp on macro things, and I believe that people should take a look at what you have to offer, and you also do a little coaching to educate people on a deeper level, correct?
Right, right. Awesome. Thank you. Well, I appreciate it. It was a pleasure talking to you.
Okay, Troy, good hunting, my trading warrior brother. Thank you for your time today.
All right, take it easy. Have a good day.
Thank you. Troy Bombardia at Bull Markets Co. on Twitter. So that's it for us, guys. Everyone have a great day. Bull Markets Co. Michael at Twitter handle. See everyone tomorrow. Good hunting. Remember, don't just count your pips, count your blessings. You're very welcome, Michael. See everyone tomorrow.